Charlie, how are you today?
I'm very good, thank you. Yeah, thank you for inviting me into your offices today as well.
Yeah, welcome to Dubai, actually. We're in the middle of the DIFC area.
Yeah.
So the Emirates Financial Tower is at the beginning, literally at the entrance of the DIFC. It's the greatest financial district. And actually, Dubai is being the financial hub nowadays. It used to be London. It's still London, but now Dubai is actually
becoming more prominent. Yeah.
So thank you for coming and visiting our office. I would like to discuss with you something related to the capital markets today. Know more about what you're doing, how your daily routines actually in the market. So let's start with the daily routines. Whenever you look at a chart, you open the gold chart, for example. And you're looking for an opportunity to trade in gold or euro or any other currency, any other product. Do you take into consideration only the technicals, or you look into the news, the fundamentals, what's happening in the market at the moment?
It's a broad brush approach. So I'm looking at starting with the technicals. When you say looking at a chart, I do a top-down analysis. So I go out to the high time frames first of all. So I'm really looking out to the monthly and even the quarterly charts. Even if I'm going to be executing off of a daily chart or a 4-hour chart time frame, I'm still going to be, as far as my analysis is concerned, it's going right the way out to the bigger time frames. So and within that's how I form my view on any given market. So it's a top-down approach, whereas a lot of traders almost use a bottom-up approach. I came from a fund management industry anyway, 20 odd years ago. So top-down approach was always how I preferred to look at the markets anyway, or look at funds. It's exactly the same with trading. So I start off by doing a multiple time frame analysis, and then I'll have a look at sentiment analysis as well within my trading. I think that's pretty important. Not just what retail traders are doing, but also what the commitment of traders reports are like. So you get a feel for what the large speculators are doing, but also just general sentiment as well. It could be headlines in the magazines, Economist, Bloomberg, you name it. Or it could just be you sense and you pick up on euphoria in the markets anyway. Just when you go on to X, formerly Twitter or whatever, you can see from all the analysts posting, when you're getting to a point in time where there might be extremes in sentiment. Unfortunately, there aren't obviously extremes all of the time, but a couple of times a year or so there will be, and it's really useful stuff. So. And then, as far as the fundamentals are concerned, on a day-to-day basis, then of course have to be aware of what news releases are coming out. And, we've got the Federal Reserve this week, the week that we're recording. We've got non-farm payrolls this week. All that stuff's important. Not necessarily that I'm executing all of the time on the back of that, but it's still important to my positions and to my decision-making over the coming weeks ahead.
Do you think, you've mentioned the central banks at the moment and the meetings, do you think that, previously, if we look back 2008, 2010, the central banks and the monetary policies and all these, the policies they were making in case of tightening or easing, they were the one leading the markets. At the moment, you think that, we've heard a lot about data dependent. We're waiting for the numbers. What will the PCE or the CPI be? So do you think the markets are leading at the moment, not the central banks?
They're trying to, aren't they? The markets have been trying to price in the first Fed cut coming in for March. It's not going to happen, as we know. And we can already see that pricing coming down, that probability coming down in Fed futures fund pricing. But that's just what the market is trying to almost bully the Fed into moving, and so the market's having to backtrack a little bit, and that's why we've seen a lot of pushback from quite a few Fed officials saying, "Hold on a second, we're not ready to necessarily start cutting as soon as you think that we're going to cut." And I think the Fed are petrified of cutting too soon anyway. From going back to the 1980s when they cut too soon, and then inflation came back, and then it became not a good time. So I think they want to have that that element of credibility, and that's why they keep pushing back against the market. But they're going to cut this year unless something happens to inflation materially.
Sure.
We'll talk about that. But it's, they're forecasting in their dot plot they're going to cut this year, and it's likely. Well, I don't know if the Fed won't lead it, but when you look at the Fed versus the ECB, might be ECB cutting first. But anyway, it's another argument itself.
Yeah, because do you think because of the bad economic situation the Eurozone actually is passing through, you think they should be cutting first?
I think they'll be around the same sort of time, but absolutely their numbers keep on coming out not too great.
The economic slowdown actually, it's much worse in the Eurozone.
Yeah, and they just seem to can't get off their knees. We just keep on seeing data coming out of the big two, France and Germany, and their PMI is not coming out well, and general data releases as far as the German business environment is concerned, it's not great. So we've got PMIs sitting at 42, 43 in manufacturing and services, and then you've got the US PMIs which are hovering around growth, back into growth territory. Well, services are anyway. So we are looking at two economies whereby you've got one which is just far, far stronger than the other. So now the irony is, when it comes to fundamentals, is that what we've seen, the euro just had quite a big rally in the face of that, just off of the October lows from late last year. So you have to take into consideration the fundamentals, but timing is everything, as we know in the markets.
Correct.
Because if you just traded, I think, solely on fundamentals, if you've got deep pockets to be able to sit back on a position, that's fine for a year or two, then they'll normally play themselves out. But as a trader, and you're holding positions for maybe a few months, then timing is important.
I do think it will be interesting for the currencies actually, because most of the traders, beginners, let's say, they think that the engine or the catalyst of the currencies is usually the dollar index. If it's stronger or weaker, then we can predict the direction of the currency. However, nowadays, because as you mentioned, the ECB might cut before the Fed, or Canada, for example, they raised rates first. And they can be the first to cut rates, actually.
Yes. Yeah.
So basically, and we know that when the central bank cut rates, actually the currency will be weaker. So do you think that we might see the euro dollar, for example, maybe going lower and the pound still going higher, and we can see this negative correlations between the currencies this year?
What, against the dollar?
Yeah.
I think that usually, as you know, they move in tandem with each other. And there's just degrees of outperformance or underperformance. I wouldn't expect to see the euro back down at, let's say, parity against the dollar. And the UK economy is outperforming the Europe as well. And then seeing the pound holding up against the dollar, I wouldn't really expect that. It's not to say that these things couldn't happen, but for me, if I'm looking at the likes of the pound dollar, the euro dollar, they tend to move in tandem to a degree. I mean, if you take it right now, we're recording this in, actually, where are we? Late January. And the pound is actually holding up against the dollar in a trading range, just consolidating, whereas the euro's been pulling back a little bit. So we see relative underperformance there right now against the dollar. But I think if the euro started rolling over, then it's highly likely the pound will be as well. But that's just my view.
I don't know actually if you followed up with the latest Japanese central bank decisions, but they're going to raise rates. Yeah. Do you think the opportunity is there this year? The only bank that's going to raise rates is Japan. And the Fed, 25 years of the deflationary mindset, it's very hard for them to step out and raise rates. They are not used to that.
No.
But if they did, imagine dollar yen would be a great sell opportunity.
Absolutely. Apart from those swaps. But yeah, absolutely. We just had the Bank of Japan last week, and Ueda was saying last week, look, they're looking out to those those rounds of wage negotiations coming up in March and April. So we are looking at the potential, and he certainly alluded last week that they could be having that first change of policy at the April meeting. But the Bank of Japan have history with saying one thing and then doing another.
Correct.
And that window of opportunity for them to raise rates could narrow if the economy starts to underperform again. So I think I'd love to see them raise rates for obvious reasons, like you've just said. I think it'd be a great trade.
Yeah.
And I think that's why we saw that strength come into the weakness, the yen strengthen against the dollar just a few months ago. And obviously it steadied itself over this past month. But it would be a very strong sell-off if it happens, yeah. But you've got to hold on for those and pay those swaps.
Yeah,
because but then again, the swaps won't be quite as bad if they're raising their rates anyway.
I might think about options actually.
Come back. Yeah,
buy some put options maybe.
Yeah.
What do you think, like when you open the chart and you want to analyze an entry point? Like we do know that looking at the fundamentals, hearing the news, you kind of gather some information about the direction you're going to take. However, like the entry points and the exit points, you need to look at the chart.
Yeah.
You need to use some technicals, some indicators. Yep. What is the first indicator that comes on your mind and you put on the chart?
I'm old school, and so I like, as far as the charts, I start off with them naked charts, nothing else on, and I'll look for anywhere I can put a trend line or a channel, and just horizontal support levels, historical levels, and resistance, and that will form the basis of just having some horizontal levels on my chart and a trend line or two if they're there. Beyond that, I love moving averages. Not because, people say, oh God, moving averages are lagging. Though they are if you use moving average crossovers. Yeah, but I use moving averages as support and as resistance themselves, like a moving trend line. And price likes to move away from moving averages, like it will do a trend line or a support level, and it will naturally gravitate back as well. So there's this ebb and flow of price moving away and then mean reverting back.
So they work like a magnet, you mean?
Absolutely.
It's like a pivotal number.
Yeah.
Whenever the price goes like beyond this area, it should retrace back.
Yes. So you get used to, as a trader, seeing that movement, and it's a very graceful movement as price moves away from the moving average within a trend, and then at certain points it'll retrace back to them as well. So I use a multiple of moving averages, short term up to sort of 50 period and 200 periods, the usual sort of medium term moving averages as well. So they'll be on my chart. The only other thing I have on my chart is a MACD. So just for momentum, and I use an MACD for at times when there are divergences in a market as well. So if a market's come into a key support zone, it's quite uncanny the amount of times when price will come into a key support or key resistance level, and there'll be some divergence there in momentum. And if I see a momentum divergence, then that will be the sort of thing that I'd look to get in on as well.
Very simple yet very effective, I think. No need to put many indicators on the chart.
No.
I usually, if you look at, for example, the Ishimoku, the Japan, it's made up of moving averages actually. Yeah. Many indicators contains moving averages inside of it, like even the Bollinger Bands. So I do work Fibonacci. I love Fibonacci a lot.
Okay.
And I work Elliott waves. It's been like more than 11 years.
Yeah.
I count waves. It's a little bit not.
Is this like a therapy for you then? Is it
correct? But like it's whenever you ride the wave, and I like to actually be on the impulsive waves, and not trade the corrective ones. So this is how I trade, but.
Well, there's an old adage, you fade the short-term trend in favour of the larger term. Correct. So, from an Elliott wave perspective, you wouldn't trade a wave 2 pullback but you'd be waiting for that wave 3.
Correct.
You wouldn't wait. So, if anything, you'd be fading the wave 2 in order to get long in anticipation of the wave 3.
True that. But basically, you mentioned something about the charts, like the top-down analysis? You mean like you start analyzing the monthly, weekly, daily, and then like, even though I don't want to trade, I don't want to take the trade for several weeks. It might be just for maybe a day or half a day, but I still look at the bigger charts.
Yeah.
You agree with that?
Yeah,
like even if you're scalping, you just need to know the bigger direction.
Exactly. Yeah, absolutely. Even if you're scalping the market, you still need to have an anchor chart. So you still probably need to see realistically what an hourly, what a 4-hour chart is, or even a daily, even if you're an intraday scalper, just to give you the levels. Because otherwise you're just blinkered. You don't see all of the levels if you're just looking at a 1-minute chart. So, all right, everyone's got their own style, but that's just a personal experience thing that I would say, you still want to see what's going on in the higher time frames and what that trend is that you're actually getting involved in. Because you must be, if you're buying, you're either with it or you're against it. So you need to see if you're actually trading against key levels or not.
I want to know more about you, and risk management is something you hear a lot. For me, I'm an aggressive trader.
Right.
And whenever I have something in mind I want to buy or a gift for my wife, I have this, like I need to make this amount.
Okay. Yeah.
So I'm very aggressive. What about you? What kind of trader you are? Like, do you abide by the rules? 1%, 2%?
Because I'm a money manager over there in UK as well, so I'm FCA regulated in London. I have to, be very strict with what I do because I'm managing clients' money.
Correct.
I obviously trade my own accounts as well, but even with those now, what I found is as I've got older, I've become less aggressive. So I was more aggressive when I was in my 30s than I am now at 51. So, and I think that's a natural evolving thing as a trader, that quite often you can be more aggressive when you're younger, and then gradually over years you become less aggressive. So no, I would say I'm not as aggressive. I'm naturally aggressive, but it's been toned down over the years now. So and I never go into the market to try and buy my wife a gift. Ever. Never do that. I never even tell her. I don't even tell her how much money I make. She does not know. If I wouldn't even tell, I might say to her, I've had a good year or whatever, but if I told her, she'll be like, right, where should we go?
Free money. Yeah.
No, let's not do that. That's my pension money. No.
So
I think one thing on that, and I think this is really important, especially for newer traders, any of your listeners who are newer to trading. One thing I feel quite strongly on is goal setting and people having goals, but not in the way that most people do it. So most people will have a financial goal. So they'll say, okay, I've got X amount in my trading account and I want to make X amount. If more traders could have a mindset more like professional sports people, then I would be happier. And what I mean by that is, if you set out to make 5% a month or whatever the goal is, you're setting yourself up for disappointment if you don't achieve that goal.
Correct.
And that brings about a whole range of emotions, frustration, all of that, and that is then carried on into your future trading. So really, for traders, the best goal that you can have is to be the best trader you can be. The money will take care of itself. So if your sole focus is on executing the best way you can, following your trading plan, all of that stuff, and all of your energy is put into being the best trader you can be, forget the goal, forget the monetary goals. They will take care of themselves. But if you're only looking at the money, then how can you be focused on being the best trader you can be? And that can, I find that a lot of new traders go down that, and I feel that's a bit of a trap. And so
when I trade, I put a take profit in my mind. I have these levels, looking forward for the price to reach. I've never waited for take profits. Never. I had the patience. Like, what would you recommend?
You don't have the patience?
I don't have the patience to wait for my TPs.
Right. Yeah. I use a lot of self-talk with traders. So I think traders need to use a lot of language and talk out loud to themselves. So one way to help a trader stay for that take profit is to say, I can't afford to bank this profit right now. So let's say your take profit might have been a 1 to 3 risk to reward. Let's just go with that. And then you've got traders, and we know this because brokers have this data, what traders do, and they'll come out at 1 to a half. And so they don't even come out at 1 to 1 risk to reward. Exactly. They're coming out less. So that their risk to reward ratio is all inverted.
100%.
And so the best way that they can help with that is to say, it'd be lovely to have this money right now, but if I just keep on taking trades like this and taking this money, that in the long run, I'm not holding on my trades for long enough. So if I take 100 trades, I'm going to end up potentially losing money here. So I can't afford to bank this right now. So using that sort of language can really help a newer trader to hold on to their profits, to whatever their target is. Because if they start jumping out early, then they're more likely to be having inverted risk rewards and more like. I'm not saying you can't be profitable with an inverted risk reward, but it's more likely that you won't
to end. Yeah. What are your thoughts about? I love to buy bottoms and sell tops.
Okay.
And
I thought you told me you just like wave 2s and wave 4s.
Yeah, that's why. Like I always wait for wave 2 to retrace and try to buy the bottom.
Oh, okay, yeah. Within a trend.
Exactly.
Yes.
But I like when the price start moving towards the direction I'm assuming. I don't like to jump in the middle of the wave.
Okay.
So do you? And we do know that selling tops and buying bottoms is not always there in the market. You can't always do it.
No.
You know, like, what are your thoughts about that? Like, if you've seen a stock market at the moment, it's already like in the hype, it's in the bull market.
Yeah.
Would you still buy the highs?
Yes, I was buying the S&P last year, and amongst all that pessimism, the first 6 months of last year was very pessimistic towards the stock market. So that was a good sign for me. The market was, as the old expression, riding that wall of worry, whereas most investors didn't believe that it could keep on going higher. Yeah. Surely we're going to go into a recession because of all these interest rate rises. It was that type of mindset from a sentiment perspective. But even now, we're coming into the new year, and actually, as of the beginning of January, I'm still bullish, and maybe we'll talk about this for the year overall. Look, there's going to be pullbacks, and we've just had this incredible rally off the October and November and December. It's just been an amazing 2-3 month run. The
market was pricing the rate cuts that's going to happen.
Yeah,
this is one of the catalysts that helped the stock market.
Yeah,
and of course the earnings and the tech companies and all these like Nvidia.
But the probabilities still are on the market side for this year. So we've come into this year on the back of the S&P did 24% gain last year. Even on the back of that, there's an 83% probability that we will end up with a positive return for the S&P again this year. It won't be 20 odd percent, but the probabilities go with that. Now, there is a spanner in the works, it's called Donald Trump, but the probabilities historically favor the stock markets and going into a presidential election year. So the probabilities actually do favor an up year for stocks. Having said that, if you're a short-term trader, then anything can happen in the near term. Nasdaq and the S&P have just broken out S&P's just broken out new highs. Nasdaq did it earlier. But of course, I think the market, a lot of participants, we're all looking for when's this next pullback coming. And I think that's always a dangerous sign, because when we're all looking for it, it doesn't happen. And that's what's happened in January. They've just carried on going higher. So I don't want to try and predict when that happens, but there will definitely be pullbacks because that's just the natural ebb and flow of things.
But now with the worldwide economic slowdown happening and what's happening like in the Red Sea actually will boost the inflation again. It will take higher, definitely, because like they're paying more on the shipments and everything. And the countries that has the more effect actually from this, what's happening in the Red Sea, is Europe and China, because China takes gas, liquid gas from Qatar through the Red Sea.
Right.
So basically, and China now with what's happening with the real estate stuff and I think the economy might face like a really slowdown, and it might spill over. We know that China always spill over what's happening in its economy to the other economies. So don't you think like the slowdown would affect the stock market this year?
Could well do. There was plenty of arguments to suggest last year that the stock market should go down, and it didn't. So I'm just going with the probabilities. So some other things that I follow as well. There's some big, and they don't actually happen that often, but we had what we call breadth thrust. We had two big breadth thrusts in the US markets last year. It's just uncanny that when you get these, there's not been a single instance in history that when these breadth thrusts have kicked in, like we had two in 2023. Prior to that, they were years before. But there's not been a single instance in history where following a breadth thrust, 12 months later, the market hasn't been higher. Mm-hmm. And the last breadth thrust was in November of last year. Look, I know that there's a lot of things going on. There's always a lot of things going on. You're absolutely right about the situation in the Red Sea being inflationary. We've got China just cutting interest rates at the moment to try and stimulate their economy. We've got what is probably going to be one of the ugliest US election campaigns coming up. And so there's a lot of potentials. And yes, the stock market may well end up down. Yeah. But I'm just saying that probability favors it being positive for this year. But we won't know until December.
As a fund manager, when you always look to... You're always looking for investments, actually, and you want the best return. So when you look at the interest rates, definitely there will be a cut this year from 5.5 lower. However, if you look at the dot plot, you're seeing that the cuts might be somewhere around 3 cuts. Let's say 4. Let's be optimistic. Optimistic. And let's say 150 basis points. From 5.5 to 4%. 4% is still high. It's still high. And many managers, fund managers, they think that, and you can see the bond market, it's recovering actually at the moment because it's giving you a good return. So why choose the stock market? This was the main question actually October, November last year. The stock market is going up, okay, but there's other options.
Absolutely. You can get 5% guaranteed on your money. So
why go for the stocks?
I totally get that, and that is a great argument. And I think plenty of people have started to dip in their toe in the water. But it's quite amazing how many people weren't when we were sitting up, when bond yields, 10-year yields were sitting higher. How many people still weren't doing it? But I'm actually a bond bull over. So in line with what you're saying, with interest rates coming down, I think one thing when it comes to interest rates, especially in the US, and this is a US thing because that's where I do most of my trading if I'm trading the S&P or whatever, or the NASDAQ, is that over there, when you look at interest rates, the impact that interest rates have on property owners is different to the impact it would have in the UK, where I'm from, for example. So most people who have mortgages, they're 30-year fixed terms. So once you've taken your mortgage out, it's fixed for the next 30 years. So in spite of all these higher interest rates in the last 18 months, 2 years, it's only affecting new borrowers. It's not affecting people who are already in the market, who are already on the property ladder, because they've got these long-term fixed mortgages. In the UK, people have to refix every 2-3 years, or sometimes 5 years, depending on what they've done. So that is an impact. For in the UK and probably Europe as well. But the US, it's a weird one that you've got a lot of homeowners who have not been impacted. And that's why we've seen consumption still actually outperforming in spite of those higher interest rates, because the consumer is saying, well, I've not moved house. I've still got this cash here because my borrowing costs have not gone up. Maybe they have on their cars, I don't know. But so... And that's where we've got to at the moment. Now, obviously the Fed wants the consumer to rein it in. They want to engineer a slowing of that economy. And if that can start to come in a bit more, which we keep on thinking it's coming in, we see some data points coming in a bit more negative, as we've seen, but then we go and see like jobs which just keep on
the
doing
strongest
so well.
in 50 years. The strongest. The job market now in the US, it's the strongest since 50 years.
Yeah. And so,
that's crazy.
Yeah, and so they would rather see a higher unemployment rate come tick through. You know, we're going to see non-farm payrolls coming up at the end of this week that we're recording this, and I wouldn't want to bet against it.
Exactly, and I do believe that the verbal intervention from the Fed last year was phenomenal. Like, he was already giving the market some room about unemployment. Like, we can go to 4.5%.
Yeah.
It was still 3.8, 3.7, you know? Like, I think he did a good job.
Yeah, agreed. Well, he's doing a damn sight better job than Christine Lagarde, that's for sure.
Yeah.
Because the thing is with the ECB over in Europe, they conflict each other a lot. So she'll say one thing, and then all right. And I know it's it's similar in a way that within the Fed, obviously the Fed members, you can have hawks and doves, but the ECB, the messaging always seems wrong and not
I think
convincing.
there's many things wrong that's happening, but definitely, like, they know better. Like, what about the emergency program, the PEPP and the APP, which is like actually some kind of you're easing the policies because you're spending some money and you know, and at the same time raising rates, tightening the policy. So it's contradicting actually. And I do think, like, I've been researching. There's a formula called Taylor's formula, Taylor-Swift formula, and it's a formula that calculates where the interest rate should be, and this formula have been like working for the past 60 years actually.
Oh, so it's not based on Taylor Swift the singer then?
No. No. He's a mathematician.
Yeah.
So basically, this formula has been saying that the interest rates in the EU should have been 6.75 instead of 4.5.
Wow.
So, yeah, like, if you think about it, like, the US raised until 5.5. Like, why the ECB stopped at 4.5%? It should have been much more higher to, you know,
I think they were very scared.
Yeah, I do think so.
Very fragile economy.
Exactly.
Yeah.
Like, it's understandable because, like, when you look at Germany and these economy, like, developed somehow economies, and then you have Portugal, you have Spain, you have Italy, you have these underdeveloped economies. Yeah. So it should have been this way actually, because, like, there should be a balance between these countries.
Yeah, and that's the problem that the Europe has, is you've got stronger economies, big economy like Germany, and then you've got far weaker economies as well, but then a blanket approach to interest rates across all economies, and some would probably be able to handle it and at higher rates more than others, and I don't know. So it's I don't relish
how was the life
job.
How was the life in UK with the double-digit inflation? Like, from a household perspective, you know, like.
Yeah, I don't pay the bills, but my wife does. But yes,
like, you felt it was. Like, the inflation was.
The only point that she manages the house. So on a personal level, was I noticing it? No, I noticed that fuel prices were quite high, obviously, but also. Heating, that was the big one that she was saying, wow, you know, a heating bill is now, you know, 3 times or whatever it was, 3 or 4 times what it used to be. I'm like, wow. So yeah, I did notice things like that. I didn't overly notice food inflation, although it was absolutely
crazy.
There.
Yeah.
And so, and it's only when someone actually says it, you know, oh, do you know how much a pint of milk is now? And oh wow, that really is. It's gone up a lot. So yeah, she would notice it more than I do, because I don't, you know, I just float around and don't know what's going on half the time. So you know, that's not a good thing. But anyway, it's just the way our life is.
Charlie, it was an awesome talk. Thank you for your time.
Oh well, thanks
Pleasure
for coming in.
here.
Wow, that's gone over, you know, so quick. So yeah, thanks for having me in, and very much enjoyed to have a little chat on.
Yeah, thank you so much
trying
for
to put the
this
world to
valuable
right.
information. Thank you so much.